This video discusses what you need to know about group accounting under IFRS. We will talk about what standards cover group accounting, what are the different investments you will eventually encounter, and what steps you can do to understand a group if it's your first time doing this. Welcome to Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now let's go back to the video. Group accounting is probably one of the most interesting niches in accounting since it touches a broad number of standards. Generally, there are 5 to 6 standards you need to read in order to be able to have a full grasp of group accounting. As a start, we need to know that some businesses are interconnected with each other, and understanding these relationships is the heart of group accounting. In a practical setting, some companies have transactions in which they acquire shareholdings of other businesses. You may know that the ownership of a corporation is split up into units of shares, and to obtain ownership of the company, you need to buy these shares from the corporation. What's more interesting is that these ownership shares can be owned by another corporation or business instead of an actual person. So in effect, it is a company owning another company. Now, to look at the balance sheet of Company A and making investment decisions out of it would be incomplete without looking into the financial statements of Company B too, especially if Company A fully owns the shares of Company B. As long as there is this connection, both their performance and financial position will be linked. This situation is exactly what group accounting addresses. It gives you the ability to see and understand the group of companies as a single entity. This is most relevant when the structure gets a little bit more complicated like this. What makes group accounting special is that there is no single way to approach it. However, there is a way to make the analysis easier by doing the following steps. Step 1. Understand a group by obtaining the structure chart. The structure chart contains all the basic information you have to be able to understand a group. As a minimum, it should contain the following: the name of the companies, the percentage of ownership that flows within the companies in the group, the date of the effectivity of the chart, and other relevant information that will help you understand the structure. This is the most crucial part to understand a group because you need to visualize the whole group before doing actual accounting work. Step 2 is to classify the types of investments that you will see in the structure chart. You should note that when doing group accounting, you are presenting the financial statements in the point of view of a single entity. This single entity will normally be the point of view of the ultimate parent of the group or the company at the top of the group structure. Classifying investments as to type means determining if the company within the group falls into one of the 4 major categories of investments we have right now. You need to assess all companies below the ultimate parent company. The standards define a subsidiary as an entity controlled by another entity, and the basic indicator of control is the investment percentage, because it normally indicates your voting powers over the most important activities of a particular investment. As a basic guide in practice, there is an assumption of control when there is more than 50% ownership to a company. However, sometimes this fact is not straightforward, as a company can have control even with less than 50% ownership, or there can be absence of control with more than 50% ownership shares. You need to always check the shareholder agreement or other relevant documents for any special circumstances that might affect the shareholders' rights beyond their basic ownership percentage. The second investment type are the associates. You have an associate when there is only significant influence over a business, as compared to control. It generally means that your ownership is big enough to matter during decision making, but not significant enough for you to be able to decide on your own in behalf of the company. Because when you do that, that would be control. Generally, there is an assumption of significant influence when the ownership is 20% or more. Given that the indication of control is more than 50% ownership, then associates would normally play around 20 to 50 ownership percentages. Similar with subsidiaries, you need to check the shareholder agreements and other arrangements that might affect this basic assumption. The third type are joint arrangements. From the name itself, it means that two or more parties have joint control over a company. Here, the parties in the joint venture cannot make decisions without the other, hence the name joint control. Unlike the first two types, there is no specific ownership that might give you a presumption of joint control rather than being equal relative to the number of parties involved. So if we have two owners, there should be 50% each. The point is that based on the shareholder agreement between the parties, no one party can make decisions without unanimous consent, and no single party can make independent binding decisions. The last one are the financial instruments. If the investment does not fall into the first three above, they normally do not fall into group accounting rules, as they are treated as regular financial instruments. Based on the above rules, normally, these are investments with up to 19% ownership. Step 3 is to determine what standards are applicable based on the type of investment that you identified. This part is extra important because you need to know the specific standards to read and study once you determine the complexities of the group from step 2. Continuing from the diagram, the specific standards that cover each investment types are as follows. For subsidiaries, since we have control, we need to use the acquisition method and apply full consolidation procedures. This is normally covered by the following standards. IFRS 10 on consolidated financial statements. It provides detailed consolidation procedures and defines the criteria for establishing if there is control. IFRS 3 on business combinations. It defines the meaning of business combinations and how you account for a company when you acquire it. This is the standard where you will closely encounter the terms goodwill and non-controlling interests. These two standards complement each other as IFRS 3 generally deals with initial recognition of a business combination, while IFRS 10 takes over the accounting after you have applied IFRS 3. When there is significant influence, the investment is accounted for using the equity method. The equity method is covered by IAS 28, Investment in Associates and Joint Ventures. Joint arrangements. The third type of investment is covered by IFRS 11, Joint arrangements. Under this standard, you will learn to further classify joint arrangements into two. Joint ventures, which is accounted for using the equity method of IAS 28, and joint operations, which is accounted for under IFRS 11. In both cases, there is joint control, but you need to revisit IFRS 11 to determine how these two types of joint arrangements differ from each other. Financial instruments are generally covered by IFRS 9. The accounting for financial instruments is outside the scope of group accounting, but we need to include this here for you to have a view of what happens to the other companies that are not within the scope of all the other investment types. Aside from the previously mentioned standards, we have two more which are relevant for group accounting. The first one is IFRS 12, Disclosure of Interests in Other Entities. This standard is used for all investment types, such as subsidiaries, associates, joint arrangements, and unconsolidated structured entities. It discusses what are the disclosures you need to include in the financial statements when you have these types of investments. The second one is IAS 27, Separate Financial Statements. This is not technically part of group accounting nor consolidation, but it is worth mentioning. IAS 27 discusses how the parent company or the investor shall present its investments in the separate financial statements, meaning the financial statements before consolidation. The next items to learn under this topic is to understand the specifics of each standard covering group accounts. We will be focusing on these in the next IFRS videos. I do hope you learned something from this. If you have any suggestions, feel free to send us a message. And don't forget to subscribe too if you want to see similar content. See you!